Hey, good afternoon, everybody. Welcome to Strategy Now at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Here I want to go over an old subject, but one to give some context, and that's using volatility as a trading tool. There's been some questions since I gave a discussion it was about 2 weeks ago for Strategy Now, where we talked about doing a call spread in the VIX, which is the volatility index. And so someone asked if I can give a little bit more background and context about implied volatility and then the utilization of that particular strategy, a bull call spread in the VIX. So first of all, I use implied volatility as a trading tool. I use it for transparency to forecast what future price movements in the stock could be. I also use it as a potential hedging tool for my overall portfolio, whether I am long or short a portfolio. So taking a look at the definition, I kind of wrote this a little bit differently than what you would normally see on Investopedia and whatnot because I wanted it to make somewhat sense. But implied volatility is a forecast of the market's opinion of the stock's potential future moves, and it's derived from the options price. So the implied volatility is not this just standalone value. It's coming from the supply and demand factor of the underlying option and the underlying stock. Now, one note here, and you'll see this highlighted right here in dark. It does not forecast market direction, okay? It doesn't forecast direction. You've always heard me say that implied volatility is not a directionally biased calculation. It doesn't care about direction. What it's giving you is a forecast. That's why I say either up or down when I'm talking about the estimated moves, because I'm deriving that estimated move calculation from implied volatility. So if implied volatility is high, the market thinks that the stock price has potential for large price swings in either direction. If implied volatility is low, it implies that the stock will not move as much by options expiration. So it's going to be in a very determined, very grindy type range. Take a look at our markets right now. The volatility index, the VIX, is trading at around $11.30. That's historically low. What has the market been doing? Staying in a range. Now we're starting to get it. And one thing that I want to also point out, this last bullet point, implied volatility and actual underlying movement are often non-correlated. What do I mean by that? Well, let's jump in and actually take a look at an example. The blue line right here is the SPX. That's the cash settled index for the S&P 500. It is also the set of options that the VIX, the volatility index, derives its value. Now, I'm not going to get into that today, but what I want you to take away from this is that the volatility index is non-correlated to the index or the stock index underlying. See, you can look at the divergence. When the market's going up, volatility tends to be low and potentially going down. But you can see that it gets into these grinding formats. When you start to see divergences, for example, if all of a sudden volatility spikes, that's usually a good indication that the market is either preparing or is in the process of starting to move dramatically or violently in one direction. In this case, down or up. Because remember, vol was up here, the red line, now it's down here, and you can see that the market violently moved to the upside. So you see that they're non-correlated. And as a matter of fact, if you take a look at today's relationship, we're looking at the charts right here. Okay? And right now, what you're seeing is the SPX trading at 2367.90, up 680. And then you're looking at that compared to the volatility index. And you see that the SPX has been grinding up here. Now, volatility had a short spike, and you see that's when the market pulled down and tested the 50-day moving average. But really, what you're seeing here is that after it tested that, it popped right back up, right? Volatility came up, the market grinded up, and volatility came down. And vol is now trading at 14, or 11, excuse me, and it was trading up at 15 here. So you see that, first of all, the market action, grinding, vol's low. All of a sudden the market drops dramatically. That session on the specific date was the 21st. That's when we had that big pullback, and you saw that volatility popped, right? Market dropped, vol popped, right? It's telling you that there is now an expectation that there could be more violent moves. It then grind. Once the market started to determine a directional bias, in this case it started to get bullish. We started to see higher highs and higher lows. Challenge not only its 50-day and settled above, but it settled above its 20-day. Again, just averages that you want to then look at in the context of support and resistance. And then it broke through, and you saw that volatility as this was grinding up. They said, fine, we're comfortable with this. Whatever event drove this, which was a plethora, healthcare reform was really the big reason why on the 21st, and then why vol stayed up there. So there was a binary component, right? Some sort of event. And then the market just has been grinding up, and volatility came down, has now been grinding down at this level of 1140. So the question that you all would ask is, well, how do I use implied volatility strategically? Well, you can use it as a potential hedge. Now, I had shown how you could do a bull call spread if your core portfolio is long. But the one thing I didn't give is some sort of ratio of how much volatility exposure should I have comparative to my long core portfolio. So in this example, the ratio of securities exposure to volatility is about $6 to 1 for small accounts. What do I mean? For every $6 that you have in equities, you should have $1 of implied volatility exposure. Okay? For small accounts, that ratio works. For larger accounts, right, for 25, 50, 100,000, north of 100,000, you're looking at more of a $5 to 1 ratio of securities to vol exposure. Okay, so for example, if you take a look at this example, I don't know if you all can see this, but it's a $4,977 account. So basically, that's a relatively small account. So I take the 6 to 1 ratio. So for every $6 that I have invested in equities, I'm going to have $1 vested in volatility. So in this case, I went $600 in volatility exposure. How did I get to it? Well, basically, with the VIX at, I believe the VIX was at 1327. I bought the 14 calls and sold the 17s. Okay. Now, this is a bull call spread. It will appreciate if volatility goes up. Specifically, if volatility goes from where it's trading today to 1507, I'm break even. If it goes to 17, I then am realizing a profit. My max risk is the difference between what I paid for the long strike, which is the 14s, minus what I received for the 17 calls, right? That's the spread. And it's $642 of risk. My max total profit is if at expiration, volatility is at or above 17, which would roughly be about $1,158. Now, that $1,158 would offset any pullback, right, in my overall core long portfolio. So that's all I was really trying to show with using volatility not only as a tool for hedging, but as I had mentioned before, I use it as a general trading tool to start to forecast what the potential move is in an underlying. All right, folks, that's it right now for Strategy Now. Join me at 3:30 Eastern Time. I'm going to go into Tech Talk, where I'm going to use this exact methodology of using implied volatility and look at the forecast for potential moves in stocks and indices that could be on the move and should be on your radar. See you then here at MarketStream.live.